Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the stock markets. I want to start here with the weekly chart of the S&P 500. This goes back to 2018 here on the left side. You see the big COVID sell-off here in early 2020, and then the Federal Reserve and the U.S. government poured in trillions of dollars into the markets and into people's pockets, and this is what happened. Then finally, here, start of 22 last year, we got inflation from all that money coming in, and the Federal Reserve was forced to start raising interest rates to try to cut that off. And that resulted here in a nice bear market last year for both stocks and bonds. Currently, we see ourselves in, and I've highlighted some of the support points here, see ourselves in a sideways pattern where the market's just going back and forth. We haven't gotten into any kind of bull market mode, but we're also not in a sell-off. This is just a bit of sideways for the time being, and actually the market's gone nowhere now in a year. Okay, let's go look in a little more detail. This is the daily chart. This shows get a little more detail. This goes back to about 2 years here, 2021 over here, and you can see this in more detail. That 2022 was just very choppy, very back and forth, but downtrend. Now I think we've gone into okay, we're still choppy and back and forth, but maybe to sideways perhaps. And in recent days, it looks like it's trying to break out and go up higher, but we'll see how that pans out. One of the things I often look at with that is some of the breadth measures, a measure of what's happening internally. And the biggest one for me is right here, the percentage of the S&P 500 that's in an uptrend. And you can see here at certain points when we rally, it's 78, 81%, 76% of the stocks in the stock market are actually in an uptrend. And when we get down into sell-offs, these match up down in 18, 12, 25. Right now it's 55. It's sitting kind of right in the middle. So we're not getting a tremendous amount of support from all the stocks in the market. In addition, this right here is the advanced decline line on the New York Stock Exchange. You can see that's flat. So these are sort of telling us that it's a bit of a sideways market. It's not saying that we're about to fall and go negative, but it's also not giving us a great reaction either. Finally, the bottom here, this is the volatility index, the VIX. And boy, this is actually coming down to quite low, which is a good sign actually for a developing rally. So a bit mixed and maybe leaning towards the upside. And I'd probably say the same about this chart that, okay, maybe this is leaning towards the upside here. We actually just in the last week had a nice little sell-off that got reversed. So maybe that will continue. Let's go into a little more detail. This is a 2-hour chart that shows us about 6 hours, or I'm sorry, 6 months of trading in the S&P 500. And you can see the uptrend that started here from mid-March, just continuing in this channel. We had a little test moving lower, and that held, and so that gave us a nice defined channel moving upward. So and as we're right now testing those February highs, so we'll see where that all goes to. The one of the biggest causes of all the bear market last year was, you can see here, this is the interest rate on the 10-year U.S. Treasury bond. And here in 2020, after COVID, interest rates fell quite a bit. Federal Reserve cut everything to practically zero. A 10-year bond could be had here. These represent 0.5%. And then as they started tightening interest rates, we saw late last year interest rates go up to 4.3% on the 10-year, and right now they're sitting at about 3.5. So certainly higher. Cost of credit cards, everything has gone higher, and that's having a little bit of an impact. But there is some talk that maybe the Fed is just about done in raising rates, and that might be positive for the stock market. Next tab here, we'll go to some of the economic news. Go to trading economics here, and if we look at the GDP growth rate, last is 1.1, previous was 2.6, so still positive, but they're certainly not blowout numbers. We're not having some giant economic boom here. The non-farm payrolls up 236,000 in the latest, which is a little lower, but again, these are positive numbers. And then I also like to look here at retail sales. They've been down last two readings, but not anything tremendous. So seems like the numbers are okay, not great, but okay. And all this is turned into here's an estimate of the analysts will go and predict what earnings are going to be on the S&P 500 coming up. And you can see here they're predicting rising earnings for the S&P 500. And if that's the case, sure, we could even in a recession, but if we're getting positive earnings because companies are managing a slowdown in sales, then it's not going to be anything terrible. And as far as valuation goes, and this kind of highlights this too. This goes back to 2013 over here. This bottom line is S&P earnings. And during COVID, you can see we did get a move down, but recently we've moved up to all-time highs on earnings for the S&P 500. So it's not there yet. This is the ratio of the S&P to the earnings, and that's actually, I mean, it's still high, but it's improved quite a bit from where we were a year ago. And these are measures of valuation. The bottom one is 10 times earnings, and this is 15, and this is 20. I think in general, somewhere around 20 is considered fair value on S&P earnings, and we're in the neighborhood. We're maybe a little high right now, but we're in the neighborhood of that. And then if earnings come up as these analysts are predicting, we come into range. So all in all, I would say here we've got a sideways market. This is where we want to play dividend stocks or other things that are paying us a little bit if we can, because for the time being, it looks like the market's just going to go sideways until it shows us that it's going to move forward over here. So hopefully this is informative and helpful, and appreciate you watching, and we will see you at the next update.